Good morning. My name is Joe Mortensen. I work for Public Resources Advisory Group. We're one of the financial advisors, general financial advisors to the city. And as Mr. Santana has just mentioned, you are definitely in good company across the nation. There are many, many municipalities, in fact, the vast majority, they're grappling with the same types of really tough situations as you are. And our job as the financial advisor to the city is to provide advice that is designed to protect the city's financial integrity and the ongoing viability of the city as a municipal government. So while we recognize that taking the types of actions that you've been asked to take are exceedingly difficult, they impact real people with real lives, with jobs, with families, we are also charged with looking after the city's long-term financial viability. And so towards that end, we would encourage the council to act on near-term solutions to the current year's budget challenges, because that will serve, if permanent, serve as a down payment on the ongoing structural deficit that the city will continue to grapple with over the next couple of years. Furthermore, the depletion of the city's cash and an over-reliance on one-time solutions in the absence of a clear commitment to the city's long-term fiscal health could have dire consequences for the city's credit ratings, as well as access to the capital markets for borrowing purposes. Ratings downgrades would have a significant increase in the cost of the city's borrowing, and that cost is additional budgetary dollars that you cannot use towards salaries, towards benefits, towards services to your constituents, and it would serve to only widen the gap that the city faces. Increased borrowing costs would also impact the city's enterprises, because perception is reality, and even those are separate enterprises, they are likely to be impacted with higher borrowing costs just by virtue of their association with the name the city of Los Angeles. And those costs would be passed on to all of the users who are your constituents. Ultimately, credit downgrades and lack of capital markets access could constrain the city's ability to borrow, to use some form of short-term borrowing in the next 2 fiscal years that would be necessary to transition from where we are today to a state of structural balance that the city is trying to achieve, and thereby jeopardize the city's ability to implement a recovery plan in the long term. The city can address these challenges, but the solutions must increase permanent expenditure reductions, because even absent the recent and unprecedented revenue declines, the city already was grappling with this ongoing structural deficit. Council has an opportunity to solve the problem and leave its citizens with a fiscally sustainable government. The budget crisis is an opportunity to rethink what core services the city should be delivering to its citizens and how best to deliver them, with the end goal of a financially stable and sustainable government that can deliver on its promise.
Good morning. I'm Lisa Smith with Gardner, Underwood & Bacon. We're one of the city's financial advisors, and just want to say I do concur with what Joe said, and I want to focus on the city's TRAN, which is a short-term borrowing that the city does every summer. We're very concerned. I've been doing the TRAN, we just say, for the past several years, so I understand the marketplace, I understand the city. I've talked with the investors interested in purchasing the TRAN, city's TRAN, every year. We're very concerned going forward this summer if there is not a resolution to this year's budget. Investors will be watching the marketplace. They look at the newspaper articles. They look at council's willingness to make changes, because it's important. You have to have a balanced budget. We have to make sure that the city is going to be sustainable going forward. I was talking to an underwriting firm yesterday, just trying to get a sense of the marketplace, and if the city could issue debt, how would it be? They thought that yes, the city would be able to issue the debt, but it would be at a much more expensive rate if any of the short-term ratings are downgraded at all. But interesting, the person said, all the investors will be watching, making sure they're not catching a falling knife. And I thought that was pretty telling subject, that you don't want to make sure that you're buying something and the city's aware of all the changes that they can make, and that they're willingly doing so. Just to reiterate, it's imperative not only that you take care of this year's current budget, but also next year, that you look at your structural imbalance and make those changes as well.
My name is Lois Scott. I'm with president of Scott Ballas Strategies, one of the financial advisors. Unlike my colleagues, our firm is not California focused. We're actually spend more of our time outside of California than inside of California. Like the city of Los Angeles, governments nationwide are really facing this very desperate financial crisis. It is not unique to Los Angeles. It is not unique to California. However, what is unique to California and what is unique to Los Angeles in comparison to the rest of the market is that typically there are three tools that you can use to get through a financial crisis. You can cut expenses, you can do one-time fixes and hope things get better, and you can increase revenues. Well, California and the city of Los Angeles does not have that third option the way other governments across the country do. For that reason, the rating agencies are much more focused on Los Angeles, on looking at your reserve position and looking at what actions you take to address your structural imbalance through budget cuts and through fiscal discipline. That is why there's a unique focus on the actions that this body is going to be taking with respect to the structural balance as it relates to the budget size. I'd like to also point out something on ratings. You are not rated as an entity. Your bonds are rated. Those are specific structuring terms and conditions that are rated. And the rating agencies look at two factors, your ability to pay debt and your willingness to pay it. Your ability to pay debt is really focused on three factors: your underlying economy, the financial strength of the organization to be managing through fiscal difficulties, and the legal provisions you offer to bondholders. The willingness to pay debt service when due is the most difficult to judge and what the rating agencies are most focused on during this current market crisis. It is the willingness to take the actions to bring the financial resources in line with the financial demands on the city that is being focused on, and that is really what is differentiating ratings. I would say that we are seeing nothing as sacred. Moody's Investor Service has been saber-rattling about downgrading the U.S. government for many months now. They're saying that not even the U.S. government is assured of a AAA rating. So while this is a tough situation, we cannot take anything for granted. You have both short-term and long-term ratings to consider. As Lisa spoke, the short-term are where we're particularly concerned because that is a short-term liquidity issue, and we need a plan to address and a presentation that shows how you can actually repay those obligations. Longer-term, the longer-term ratings are more focused on the economy and the long-term health. The third area I'd like to speak on is the impact of your financial crisis, not just on rating agencies, but on investors who set your interest rates and who actually make the contract with you to lend you money. The investors who have been burned by the rating agencies and they're concerned about rating agencies' role in the fiscal crisis that we all find ourselves in, have really taken it upon themselves to do independent financial research on individual credits. They're taking a much closer look at all of the factors individually and separate from what the rating agencies might be saying. Those are the investors that will be setting your interest rates. Your short-term borrowing is typically purchased by money market funds. Money market funds have just come under new regulations passed January 27th, which significantly restrict their ability to invest in Tier 2 securities. That is going to drive the market. If you lose your highest short-term ratings, there will be very significant financial consequences to the city. The longer term is hopefully a little bit more focused on the economy. And I can also speak on, should you like, on the impact of your fiscal situation on the probability of success on your P3 financing ideas.